Hello, everybody, and thank you for joining us for our weekly market update call for Monday, July the 27th. I'm Jay Gragnani, and here joining me this week is Steve Raymond. And, as we embark now on the last week of July in the market, as we turn the calendar to August this coming Saturday, I wanted to take a few minutes through this call and talk through some recent market events, specifically as it relates to last week's market environment as a market that generally the S&P 500, the headlines, the S&P 500, Dow have the first down weeks after a few positive up weeks, but certainly not the case across the board, and even some sectors doing pretty well last week. So review and examine that, where those areas were of strength and opportunity over the course of the past week. And then also talk about some of the positive developments that we continue to see out of the chart of the S&P 500 specifically, as well as improvement across a number of not only equity groups, but also a number of recent score improvement from a number of fixed income groups. And that improvement within a number of fixed income areas goes hand in hand with one of the changes that we did see with respect to DALI last week, and DALI being standing for dynamic asset level investing, as we saw fixed income as an asset class overtake cash to become the #1 ranked asset class, and we'll dig into that a little bit more. And then lastly, the U.S. dollar has been something that has come up quite a bit, and wanted to provide some updates on the U.S. dollar, where that stands today, and what we generally tend to see in market environments across various asset classes during environments in which the dollar has been weak, which certainly has been, that recent time period today. And so as we look back at last week, the S&P 500 was down less than 30 basis points. The Dow Jones Industrial Average down about 0.75%. And so, it's interesting to see as a lot of the leadership groups in the market over the course of the year, technology, consumer services, healthcare, those were the sectors that were, pulling back or taking breathers last week. Whereas you look at the top end of the spectrum, at least on the U.S. equity front, and you see areas like energy had a good week, up over 2%. Financials, consumer discretionary also up over 1%, and other asset classes too. Gold obviously has been a big headline story. Gold today moving to new all-time highs. GLD, which is the Spider Gold Trust, up over 5% last week, and up now over 25% on the year, as being one of the real bright spots in the market this year. Outside of that, even bonds and momentum stocks in general had a pretty good week, as you go back and you look. But as you look around at the performance trends, and the week picture doesn't necessarily tell the whole story, as there's been a lot of leadership trends amongst the technology sector, which continues to be the strongest sector out there as we look at those sector ranks, broadly speaking, and then communication services and healthcare certainly right up there as well. And so just kind of a quick review there. But as it relates specifically to the S&P 500, we did see a notable breakout, Steve, on the S&P 500 chart last week. This one looking at the 20-point chart, with the move up to 3240 and clearing that resistance that had built up there at 3220 for quite a period of time.
Right. We've kind of been in the same boat, through the week, with sellers coming in and hitting the market as we would expect them to. But we're continuing to see the positive trend of the market. We still have the same trailing stop alert at the 3,100 level on the S&P, and we still have basically the same upside target, which is basically the prior market high over the rolling year period, which can be referred to, some call it the E-Trade high, which was that last day of the high market value before we started selling off, in the March, February timeframe. As we were coming down. So we're still in the same boat. We expect sellers to hit that prior market high. We expect the market to challenge that zone as well. Some sellers hit, but I think we're still maintaining a positive trend, and that's what we keep our eye on. If we break the 3,100 trailing alert level, that gives us a chance, gives you a chance to, kind of get back in there and assess what's going on in between there and that possibility of hitting a 3100. This is just expected bandwidth of movement. With the VIX still, at 25, your daily move is expected to be 2.5% in the market. If you take twice that, which is, can occur from time to time, that'd be a 5% move as well. So we're still in the part of the journey where, the market can make some big moves and be down and then come back up. That type of volatility is still very much expected, very much planned for. And we'll just continue down the road, monitoring these trailing stop alerts and quite frankly, look for the market to, hold its strength and unless something changes. And that's what the daily and the weekly and the monthly evaluations are there to help us make sure we're on those things. Back to you, JG.
Yeah, it's you talk about the volatility and certainly there's still a lot of unknowns out there in the market as investors try and digest everything that's coming out from COVID testing to vaccine potentials to further stimulus bills and everything out there. And so, it's important to maintain some perspective through all of that and using, trend lines and support levels, especially on something like the S&P 500 and monitoring those levels. Going forward as we move through the week, will certainly be something to be sure to be aware of and be cognizant of. And, as we turn the calendar to August and then, you're not from that point far out from elections. And, that's potentially been the forgotten thing so far this year with everything else going on is that there is a, presidential election that is to come here in the U.S. Later on this year. So that will be something to continue to monitor and watch going forward. And all the more reason to use these types of indicators to maintain some perspective for you as well as for your clients out there as we move throughout the year. And one of those ways to maintain a bit of perspective, in addition to just monitoring absolute support levels and key resistance levels on things like the S&P 500, is monitoring things like the asset class group score page, which is going to organize the groups that we follow, which is about 135 different groups that we rank inside of the asset class group score page based on a technical fund score. And those scores range from a low of 0, which would be seen as very, very weak, to a high of 6, which is the best, the strongest score a fund, mutual fund or ETF can have. And then within those groups, the average group score just simply averages all of the scores amongst the members of that group to come up with that average score across the board. And so when we look at the macro view, which is a kind of high level view across broad asset classes, we see a handful of groups up there in the 4s, with the S&P 500 being the strongest right now as we move through the market. But there's been some interesting developments so far within the macro view.
Yes, there has. One thematic that's been consistent here is the core of the market, as noted by the S&P 500 related funds, maintains a number 1 ranking, and that's important because that tells us that the core of the market's very important, in an asset allocation point of view. The core of the market's running at the 83rd percentile, which means it's performing at or better than 83% of the asset classes around the world, and that's a pretty what I would call strong and dominant reading from that core. On the other end of the football field, the money market percentile rank has moved back down below the 20th percentile. Remember, as we mentioned, it was hovering around that quartile level, that 25 percentile, moving back and forth, and here we have it down into the teens again. So that would be a bottom quartile level, no doubt about that. And historically, money markets normally travel that bottom quartile, even in normal market conditions. Sometimes we see the money market percentile rank get down into the below 10 level and spend a lot of time down there. And that's more of a blue sky market where things are really smooth and a lot of functionality to most asset classes. I'm not saying that we're there at this moment, but we're definitely in the bottom quartile. So you do have that offensive tone, meaning that a lot of asset classes are presenting an offensive tone that are functioning, at or better than money market. And that's really a very vital statistic for, asset allocation, with that in mind, that you can participate with a lot of groups and get some functionality from those groups. We still see a, healthy showing by the fixed income market as well, with the all fixed income still striking above the 4-score area, which is interesting because that is a high level for that group, all fixed income, historically. And so we do see some good participation there, and you need to keep that in mind, obviously, when you're in an asset allocation environment. Fixed income is extremely important, and depending on your point of view, could be the most important, right? But so the real challenge here is the core of the market battling the fixed income market. Both are strong. We're in an era where both are strong, and certainly for months, or let's say the quarter or two, or as many quarters out that this phenomenon is occurring, you have to look at that fact that the fixed income and equity, or you could say equity and fixed income, are both vital to the pursuit of a asset allocation that's in harmony with the market. As well as that, we have good showing by the emerging markets and the global and international markets, both scoring well above 3, which as we mentioned over the weeks here, was occurring, and now that they have become solid citizens or better citizens, that gives you the entry point to say, hey, let's find out what funds that you could use to go ahead and put into the to the allocation mix. Back to you.
Yeah, it's certainly interesting when you look across the board and you see such a strong showing out of S&P 500 or core markets, but also fixed income continuing to do well. And you mentioned emerging markets, and I think one of the other views that is really interesting and some way to get a little bit more granularity in terms of what's going on underneath the surface. If you lift up the hood on the asset class group score page and opt to view all groups, so you have the option when you first go to the page, you get that macro view, which is what we just looked at, but you have the option to change the view and what groups you see. But you might just want to see U.S. funds or maybe just non-U.S. funds. So this is looking at all groups, so all 135 groups. And we've ordered this page here by the score direction. So in other words, which groups are showing the most improvement within their average group score. And when we look at the list, the hit list here of those groups that are the most improved, we mentioned, Steve, basic materials as last week was the most improved. We've seen precious metals now move into the picture, given the strength that we've seen out of precious metals, not only gold and silver, but the actual underlying stocks as well.
Yeah, it's pretty incredible. It's part of this theme where I think this particular view uncovers a thematic that's very important. I'll start with the bigger one of those important thematics, which is this is not a narrow market. These groups, and there's more than you can count here, which have high score directions, are demonstrating that they're also participating on the buy side, the money flowing in and things improving. And this breadth or widening of the market is one of the clues of why we have some confidence that this market, can continue to voyage northward. I mean, you can't count on any particular group to carry all of the allocation, but you certainly can say there's enough asset allocation groups improving that clearly this is a broadening market, and clearly we should participate with that market. With that said, there are various groups, honorable mentions, I could say, that are important to note. JG mentioned one, that the precious metals and basic materials are definitely showing something that's going on in the basic materials and metals. You could even say commodity space, which is very interesting, to say, hey, these are some groups that, maybe you have participated with so far. Maybe you have not participated so far, but I think that there's an interest here to say increased weightings could occur in those spaces. Clearly, on another note, the international space is really picking up, as we've been noting, and the international scores are, showing a very high score direction. China being one, but some people say, well, I need something a little more broader than a Chinese, position. Well, yeah, of course you do. So a general emerging markets fund is up, about 3.7 points, of the score, and is up to 2.35 points in score direction. So it's a major inflection in the emerging markets on a diversified basis. Think of, buy the EEM or buy the Dorsey Wright product, the PIE. On the mutual fund side, you could say, let me go to New World from American Funds, the most conservative emerging market funds out there that's really managed and actively managed. And all those are great choices to say this, because of the improvement in the emerging markets, how do I participate? I want to start adding positions or add more positions. And those are the thoughts that, clearly come through and say, hey, this is a good showing here. It very well could continue. And you're toe dipping in there and taking advantage of the space. I'll make another notable mention along that line is that the way the score direction page is ordered here, you see groups by their score color code. We don't change the score color code simply because we reorder the groups by score direction. And Latin America kind of stands out here because it's still red. The red means it's down in the kind of the low score range. But it's high up on the page because of a high score direction. So that gives you kind of an instant match of here's a low group, considered down and out group, participating in high score direction. That might be a great value idea right there. The chance that the Latin America is still low, but improving, for those that want to take on and add risk on and other areas of thought, that group stands out as a low side group that's making tremendous progress. The last honorable mention I think I'll make is convertible bonds is the highest score direction fixed income group, if we could say all that in one sentence. And that would mean that the convertible bonds have really had a good showing here. You've got a score of near 490, and you've got a score direction up 2.31 points in the recent run. Remember that convertible bonds have a 0.72 correlation to the S&P 500 index market. And so sometimes people say, that's a pretty good equity surrogate, although it's a fixed income group. And I think definitely that's a way to participate in that what you call the twilight, which is traditional fixed income versus traditional equity. And the twilight between the two, convertible bonds has behaviors of both macro asset classes and can give you an edge to get in and participate really on the good things on both sides of those markets. So please look at the score directions and review that, as you can over the day and the week ahead of us. And I think you'll come up with some excellent ideas of saying, what can we add to the allocation to make it a little better, to make it a little stronger, to make it in more harmony with what this market is telling us to do. Back to you, JD.
Yeah, and that, that last point on, the fixed income kind of goes hand in hand with when we look at the DALI page. And we mentioned at the beginning that fixed income moved up to #1 in DALI. And when you look at DALI today, it is, certainly those areas of the fixed income market that tend to have less correlation to traditional fixed income, i.e. treasuries, and some certainly more correlated to the equity market. So things like preferreds and convertibles certainly up there, strong names within those groups. U.S. corporate, U.S. high yield, those are among the stronger groups that within the fixed income asset class have been the ones that are really driving the strength underneath the surface within fixed income. And you can see that, fixed income just recently moved up. Cash is sitting down at #2, having lost a number of signals. As a matter of fact, we'll look in just a minute. Cash and fixed income have lost signals within DALI over the course of the past couple of weeks, or really the past week, but cash has lost more. So fixed income took that #1 position. Talk a little bit more about that in a minute. As we look down on the equity side, you see that the same general trends prevalent there, where amongst the style boxes, growth continues to dominate the value counterparts by and large. And then from the sector standpoint, you see the technologies, the discretionary, energy still hanging around up there in the top 3, and then communication services and healthcare being among the leadership groups from the sector side. when we look at that now, one of the ways that if you're looking for ideas within fixed income or any of the other asset classes, right off of the DALI page, you can click on the different boxes. So if you were to click on the U.S. preferred and convertibles box there within the fixed income asset class, you will get a page that looks something like this. And what it's designed to do is very quickly highlight some ideas. ETFs is this view. You can click on mutual funds from this page as well to get a list of mutual fund ideas. But it's going to take those ETFs that are classified as preferreds or convertible bond ETFs, and it's going to rank those by their fund score. And we can see that, the convertibles, there's an iShares convertible, there's a First Trust strategic convertible, there's a Spider convertible, all of those showing good scores with, north of 4.5 in the First Trust and iShares product, both into the 5s. And you look at the chart on the right-hand side, and that's just, an example of one convertible ETF from First Trust. It's an actively managed fund that has, you cover up the name, and that was one of the always things. You cover up the name on the chart and ask yourself, is this something that I would want to buy? And that is a chart that is showing a clear picture of demand being in control. You've seen a number of consecutive buy signals, 4 consecutive buy signals off the bottom. So, within the convertible bond space, you've been getting this consistent series of higher tops and higher bottoms out of this one specifically. But, if you pull up the iShares version or any other number, you can see very similar type of pictures where demand is in control here. So, again, to, piggyback a little bit on what Steve said, is just as you're looking for ideas to either allocate towards your fixed income bucket or just ideas that are something that you want to add to the allocation, preferred and convertible specifically here are certainly something to be considered as a leadership group within fixed income. If we go back to the comment kind of the ranking, the buy signals within DALI here recently. If we look at the top of the chart here, what this is showing is DALI history going back, using basically weekly snapshots. And over the course of the past week, while both fixed income and cash have lost a few signals, cash has lost a few more. Therefore, fixed income moved up to number 1. And really where those signals were coming from was commodities. Commodities has picked up almost 20 signals just in the past week. And, that is certainly a direct function of the recent strength that we've seen in gold and silver, as well as crude oil. And, we've mentioned the metals, but crude oil, the chart of crude oil, CL / so the continuous crude oil chart, just recently actually moved back into a positive trend. So, we're seeing some positive developments out of the commodity space, and really that has come on here recently in terms of a relative strength position as commodities is picking up a number of signals. With that said, though, if we go back to the end of March, international equity has actually picked up the most net new buy signals at 52, and domestic equities has picked up second most at 50. And a lot of those signals within the international front have come from the emerging market space. So not too surprising, seeing the improvement within the emerging market space in China and India. Those areas are showing improvement, and we're certainly seeing evidence of that, while international equities as an asset class at large is still down there in the ranks. There has been some improvement brewing underneath the surface, and that's really coming from some of the international areas today. And those themes, the improvement within commodities, the improvement within international equities, those are things that are consistent with other periods of declining U.S. dollar. And so really, the U.S. dollar peaked back around 102.50 earlier this year, but since then has been generally producing lower tops and lower bottoms, and certainly the exact opposite picture of what we were looking at on the convertible side, where the U.S. dollar has gotten weak, moved into a negative trend, actually violated the March lows here just recently, just at the end of last week, moving down to 94.50. And so the trend of the dollar being negative here is certainly something that is going to be continually worthwhile to watch. And there's not, when you look at the U.S. dollar and just market performance, as defined by, say, the S&P 500, the difference between the performance during strong dollar and weak dollar environments for the S&P 500 is negligible. Both have produced absolute returns during those time periods. But where you see, really big opportunities in weak dollar environments are things like emerging markets and non-U.S. equities, as well as other areas of commodities. And so those are certainly some things to continue to watch and monitor, especially if you see the dollar dip below that 93 level, which is some support that was built up from back in 2018. That would suggest that there's more downside to be seen from the U.S. dollar. So that 93.50 area, 94 area will be important to monitor going forward. And those looking for ways to perhaps more directly take advantage of a weak dollar, there's a couple ways to do so, and there's a couple of ETFs that Invesco has. One is a bullish dollar ETF, UUP. The other is a bearish dollar ETF, UDN. So if you're long UDN, you are, as the dollar is going down, that portfolio is benefiting from that. So if you're looking to take a position that is short the dollar, UDN would certainly be one way to do that. Be cognizant of those products and K1 statements. They are investing in futures contracts, so those products will have K1 statements attached to them. So just something to be aware of. Another way to kind of look at the currency market is through a model that we have on our website, which is a currency model, which predominantly uses Currency Shares has a suite of individual currency products. There's also some other, baskets of currencies in there, but it's a model that's designed to tactically rotate across different currencies, and it came out here recently. Basically, came out of dollars, of money market funds in U.S. dollars, and the most recent trade was into the Australian dollar. And the Australian dollar, just recently moving into the portfolio here over the course of the past week, and that is doing so as the Australian dollar is breaking back out into a positive trend for the first time in over 2 years. So, it moved into a negative trend back in April of 2018. It's now back into a positive trend here for the first time in over 2 years. And the Australian dollar is added to a model that already holds the euro and already holds the Swiss franc. So, just one way, if you're looking to take advantage of opportunities, across the currency asset class at large, that model is available through the models page on the website right now, as well as a number of other guided models out there. So with that said, as always, if you need some guidance on where to find anything that we talked about today, whether it's views on the asset class group score page, whether it's individual positions of an ETF, you be sure to log in, contact us if we can be of any assistance to you. As always, we'll continue to monitor the markets, continue to identify leadership trends that persist in the market, and also keep you up to date on any changes that we see, across any models or DALI asset class group scores as well via these calls. Also, the best, most up-to-date source of information is through our daily equity report. It's a research report that we publish every single day through our research platform. If you have access to that, you can log in there, view that under research. If you don't have access to that, I would highly encourage you click on the dorseyright.com, take a free trial of the research. Gives you a trial for about 30 days, and we can set up some one-on-one time to walk you through the website, talk through the different tools and resources that are available to you. So as always, I hope everybody is having a good summer, hopefully taking a little bit of time, a little bit of rest and relaxation with the family, and hopefully, above all, hopefully everybody is staying healthy and safe out there. So as always, we appreciate you joining us this week for this call. Look forward to talking to you next week. And next week will be the first call of August. So take care. Talk to you soon. Thank you.